If you run a $2 to $10 million marketing agency and still don't trust your P&L, this video will show you exactly why the numbers feel wrong and how to fix it. So over the past few years, I've reviewed the P&Ls of over 50 marketing agencies, everything from $2 million shops to $10 million plus. Paid media, PR, performance, SEO, creative, full service, the whole range. And there are patterns, like the same 5 or 6 things that show up every set of books. And most of them are costing the founder real money, and they don't even know it because nobody's actually ever walked through the business and the P&L with a strategic lens. So that's what I'm gonna do in this video. I'm gonna show you the most common things I find, why they matter, and how we fix them. And I'll give you the framework you can use to start reviewing your own numbers differently today. The number one thing I see, and this is across almost every agency I've reviewed, is that gross margin is either wrong or completely misunderstood, and it's the most important number on the P&L. So let me explain what it is and what to do about it, because a lot of agency owners think they know, but they don't really know. Gross margin is the revenue minus the cost to deliver the service, and that's it. For an agency, that's mostly your labor, your designers, your media buyers, your strategists, your project managers, your subcontractors, the people and the costs directly tied to doing the work for clients. What's left over after you subtract those costs is your gross profit, and your gross margin is just that number as a percentage. So if you're at 4 million in revenue and your direct delivery costs are 2 million, your gross profit is 2 million. That's a 50% gross margin. For every dollar of revenue, 50 cents is left to cover everything else. Your rent, your software, your management team, your marketing, your profit. And now here's where I see it go wrong. A lot of agencies either lump everything together into one bucket, like all salaries into one line item, delivery and admin mixed together, or they put things in cost of goods that shouldn't even be there, or they leave things out that should be there. And if gross margin is wrong, your pricing decisions are based on bad data. And I want to be clear about one thing. Gross margin and net margin are not the same number, and a lot of founders use them interchangeably. Gross margin is revenue minus direct delivery costs. That's the cost of the work. Net operating margin, or operating income, is what's left after you also subtract your overhead, your management team, your office, your software, your marketing costs, and your admin. All the stuff that runs the business but isn't directly tied to a specific client. So an agency might have a 65% gross margin but a 15% net margin, and that 50-point gap is your overhead. And understanding that gap is critical because that's where all your reinvestment capacity lives. So across the 50 agencies, here's what I found. When gross margin is above 60%, the agency generally has enough money and room to reinvest into marketing, into senior hires, into reducing key person risk, into building the things that make the business more valuable. But when it's below 60%, that's when things start to get tight. There's not enough margin to fund growth and maintain profitability. And when it's below 50%, you're basically running on fumes. You might have great revenue, but there's no money left to actually build anything. And that's the trap I keep seeing. Busy but broke, record revenue, no cash. And the reason is usually right here. Gross margin is too thin, and nobody's been watching it. The second biggest mistake I see across almost every agency, the overhead section of the P&L is a mess. And by mess, I mean it's just like one long list of expenses with no structure. You've got your software subscriptions next to contractor costs, next to the CEO salary, next to some random conference expense. It's just a wall of line items. And when it's structured like that, nobody reviews it because it's too overwhelming. The founder just scrolls past it. The bookkeeper technically coded everything correct, but it's not set up in a way for decision making. So here's how we restructure it. We break overhead into 4 buckets. Sales and marketing, everything you spend to get clients, your ad spend, marketing tools, conferences, sponsorship, sales team costs. This is your growth investment. Management admin, that's your leadership team and your admin costs. Payroll taxes and benefits, self-explanatory but important to isolate because it scales with your head count. As you grow this number, it grows proportionally to your payroll. Other operating expenses, everything else, professionals fees, insurance, miscellaneous. And if you want an extra account, you could keep subscriptions as a separate one. I know with lots of agencies, subscription costs tend to get out of hand, so it's good to track those on their own. Now this one's important. We like to keep income tax, amortization, and government grants below operating income in a separate account called other income and other expenses because those are items that distort your operating picture. If you got a 200K government grant, it's sitting in your revenue mixed in with your overhead. It's distorting your actual financial performance and decision making. So we pull those out so that the operating income line is clean. And the reason this matters is that once you've got those 4 buckets, you can actually ask useful questions like, is sales and marketing spend going up? Good, as long as your revenue is going up faster. Is management and admin creeping up as a percentage of revenue? That's a flag. Are payroll, taxes, and benefits growing faster than headcount? Something could be off. Without the buckets, you can't really see any of that. It's just a number that goes up every month and nobody knows why. And most importantly, it makes it hard to budget. With better structure, your forecasts and budgets will be more accurate and you'll make better decisions. The third problem I see, and this is probably the biggest one, is that nobody is reviewing the P&L strategically. The books get done for tax compliance. The P&L gets produced. Maybe the founder glances at it, but nobody sits down and says, what is this telling me and where do I invest and what do I cut? So we use a framework called PPC, and that stands for price, productivity, and cost control. Those are really the only 3 levers you have on the P&L. Price, are you charging appropriately for the value you deliver? This is the highest leverage one. A 10% price increase on the same delivery cost drops almost entirely to the bottom line. And like I've talked about in other videos, if your close rate is high, like above 50%, that's usually a sign you can raise your price. Productivity, is your team being efficient as possible? What's your utilization rate? How much revenue are you generating per labor dollar? If you've got people on the team who aren't fully utilized, that's gross margin compression. Not because they're bad at their job, but because the work isn't there to fill their time or the workflow isn't efficient. And lastly, cost control. And I know this one sounds boring, but I keep seeing it make a massive difference. And this is where we go behind the scenes and look at overhead. We look at every line item and ask, has this cost increased? Are there new vendors present that weren't there last quarter? And for every cost, there's one simple test. Does this drive an increase in revenue or increase in productivity? If the answer is no, it's time to cut it. And I want to give you real numbers on this because it sounds small until you do the math. But being diligent with cost control can easily save you an extra 5% on the bottom line per year. 5% doesn't sound like much, but 5% on 5 million is 250K a year. That's one senior hire, a full marketing budget. That's real money that was just leaking out in subscriptions, redundant tools, or vendors that were never renegotiated and expenses that weren't tied to anything. I've seen agencies where we found 15 to 20K a month in costs that the founder didn't even know existed. Not because they were being reckless, but because nobody was reviewing the overhead strategically. The bookkeeper coded it correctly, the P&L was technically right, but nobody asked, should we even be spending money on this? That's the difference between books that are done for compliance and books that are done for decisions. The fourth problem I see is founders looking only at 1 month of financial information at a time. And this is probably the simplest change you can make that will immediately improve your understanding of the business. Stop looking at 1 month by itself. I see this constantly. The founder pulls up the P&L, looks at the current month, and either panics or celebrates based on that one snapshot. Revenue was down in March, okay, but was it down because you're shrinking or because February was an anomaly? You can't tell from 1 month, so we always analyze the P&L using 3 views: a rolling 12, a rolling 3, and a current month. The rolling 12 is the sum or average of the last 12 months. This smooths out all the noise, seasonality, one-time spikes, slow months, and it shows you the real trajectory of the business. The rolling 3 is the last 3 months. It tells you what's happening right now. It's recent enough to catch trends, but long enough that one weird month doesn't throw it completely off. And then the current month. It's useful to spot things that just happened, but it's the least reliable on its own. So here's how you can read them together. If your rolling 12 is trending up and your rolling 3 is also trending up, good. The business is growing and the recent trend confirms it. You're on a good path. If your rolling 12 is trending up, but your rolling 3 is trending down, that's not automatically bad. It depends on the context. If you deliberately made an investment into growth, like you hired 2 people or you doubled your ad spend, and the rolling 3 reflects that cost before the revenue comes back, that can be totally fine, as long as you made that investment intentionally and you've got a plan to see the ROI within the next 6 to 12 months. But if your rolling 3 is trending down and nobody can explain why, that's a flag, because the rolling 12 is a lagging indicator. It'll keep looking good for a while even if the business is softening. The rolling 3 is your early warning sign. The worst scenario is when the rolling 12 is trending down and the rolling 3 is trending down. That means the problem isn't new and it's just getting worse. That's when you need to move fast. And the mistake I see most often is founders making decisions off 1 month. They had one bad month, so they panic and cut costs, or they had one great month, so they hire 2 people. Neither decision is based on a real trend. It's based on noise. The rolling 12 and the rolling 3 take the noise out. The last thing I want to cover is the 50% rule. And this is really the bridge between reviewing your numbers and actually making better decisions with them. When an agency is thinking about making a major growth investment, a new hire, a new channel, a big technology build, a market expansion, the question is, how do we know this is worth it? And a lot of founders just move on gut. It feels like the right move, or other agencies are doing it. We need to spend more to make more money, all of which are true, but there's no framework for evaluating whether the investment actually paid off. So here's what we use. For any major growth investment, we want to see at least 50% net profit added, meaning if you invested 100K into something, we want to see that 100K come back plus 50K in additional profit over the next 12 months. So you're not just breaking even, you're earning a 50% return on that capital. And that 50% hurdle matters because growth investments carry risk. Some of them won't work, so the ones that do work need to work well enough to cover the ones that don't. And I'll be honest, most agencies aren't tracking this at all. They make the investment, they move on, and 12 months later, nobody goes back and asks, did we actually produce what we expected? That's what we do on the CFO calls. We tag the investment, we set the target, 100K in, expecting 150K back in 12 months, and then we track it. On every monthly call, we're looking at, is this investment on pace? Is the rolling 3 showing the early signal? Or did we make a bet that isn't paying off and we need to cut our losses early? That's what a strategic P&L review actually looks like. You're not just reading the numbers, you're using them to make decisions, where to invest, what to cut, and whether the bets you've already made are paying off. If I had to summarize the 5 things I see across almost every agency P&L I review, 1, gross margin is either wrong or misunderstood, and if it's below 60%, that's the first thing to fix. 2, overhead is an unstructured wall of expenses that nobody reviews. Break it into 4 buckets: sales and marketing, management and admin, payroll taxes and benefits, and other. Keep taxes and amortization and grants below the operating income line. 3, nobody's reviewing the P&L strategically, using the PPC framework: price, productivity, and cost control. Every overhead cost must drive revenue or productivity, otherwise it's flagged. 4, stop looking at 1 month. Use the rolling 12, rolling 3, and the current month together. Read the trends, not the snapshots. 5, track return on invested capital. 50% net profit added for every major investment within 12 months. Tag it, target it, track it. We use the P&L to review and make better decisions about where to invest, what to cut, and whether we're on track to hitting the goals we set out in the value creation workshop. That's really what all this connects back to: building enterprise value deliberately by solving the right constraint in the right order. If you're running a $2 to $10 million marketing agency and you want us to review your P&L through this lens, we do a free agency profit benchmark and valuation workshop, and that's where we diagnose your primary constraint and show you what fixing it is actually worth. There's a link below to apply. And if this was useful, subscribe. I'm going to be doing a lot more of these: real numbers, real agencies, real patterns. Thanks for watching.